All right, I guess I get to talk everybody's favorite topic, and that is the US economy and what's going on with the US economy. And I think there's two sides to look at when you look at what's going on in the US economy. There's the consumer side, and then there's the manufacturing side of the economy. And really, when you start looking at what's going on in the consumer side, I think the areas that have been talked about probably the most in recent years has been what's going on with inflation. So here on a chart behind me, I've got our retail sales, so from the Bureau of Labor Statistics and then the Bureau, I blank completely, but it's the total retail sales number, and it's pulled out for the last 2 years. So looking back the beginning of 2023 through the October release and kind of see that the consumer price index, so that widely measured use of inflation, has actually rose faster than overall retail sales. So looking at about 5% increase versus about a 3.6% increase in sales. What's interesting is when you start looking at what has happened over the past year, take out gasoline, because gasoline's one of the most volatile areas that John will allude to a little later, but it's been deflationary. So when you factor in core inflation, so remove food and remove energy, prices are up about 3.3% year over year. Well, look at retail sales, take out gasoline and take out motor vehicles, up about 3.8% year over year. So kind of an inflection point that we've seen where sales are starting to outpace inflation once again. Overall, fairly solid sign for the economy. Now, flip side is the consumer's been really what's driving the economy forward, really since COVID. Touch on that here in a minute. But one of the things that's quite interesting is the reliance on credit over the past couple years. So here, looking at total outstanding revolving credit. So think of this largely as credit cards against the Fed funds rate. So the rate at which the Federal Open Market Committee sets on a, I don't want to call it a monthly basis, but fairly regularly they meet. I think it's about 9 times a year. We've gotten 2 interest rate cuts this year. So we've got 50 basis points in September. We got another 25 basis points at the beginning of November. We've got one more meeting this year. And expectations, when you look at what the Fed released, or the FOMC released in September, you're looking at another basically 25 basis points before the end of the year. They've got one meeting in December. We'll see if they come through with that. And then looking into 2025, expectations are for another 100 basis points from there. So really seeing a reduction in interest rates, which is overall a positive for the economy because it helps drive investments, spending, things like that. I think what's interesting, though, when you look at this chart that's up here, is the reliance on consumer credit and the amount of debt consumers have taken on over the past couple years. So pulled this out, 108 months dating back 2011 through right before the pandemic hit in 2020. The outstanding revolving credit, so again, credit card debt, increased by $206 billion. COVID stimulus happened, paid off a lot of that debt, started accelerating. In April of 2021, through the most recent month we have, added $382 billion in that debt. So just kind of shows that the reliance on credit or the use of credit has been there. I think what's interesting is when you start looking at what the consumer is actually searching for, it's been a search for value. I think it's never more evident than what we've seen in the past few weeks or days, really, when you look at Walmart and Target earnings and the big discrepancy in the two. You had Walmart with strong sales, strong comp sales, really highlighting the search for value. You had the flip side, you had Target, and with them, it was comp sales kind of sluggish, but then you look, discretionary spending down, search for value, things that they hadn't brought in, that value element to it. So kind of a differing consumer searching for value, and I think that's the key takeaway when you're looking at where we're at in the economy right now. I think the flip side of this is when you look at what's going on in the manufacturing sector. It's been one of the areas arguably talked about the most as around freight demand and where it may be lagging, whereas the consumer side's been quite strong. I think one of the interesting things is when you look at what's happening in the manufacturing sector, it's been in contraction for 23 of the last 24 months. Basically 2 full years of contraction when you look at the Institute for Supply Management's Purchasing Managers Index. So really highlighting the sluggishness in the overall manufacturing sector of the economy. Part of that becomes from higher interest rates. Capital investment lags in these investments in manufacturing because who is going to make the investments when you can get 5% in return with doing effectively nothing? So I think that's an area, as we see lower interest rates, it helps drive some of this investment in manufacturing and ultimately will help lead to a recovery in there. Craig's talked about the tariffs and the reshoring and those efforts, and ultimately that's going to help boost this manufacturing sector that is needed because, again, the economy really has been driven by the consumer for the better part of 2 to 3 years, maybe even longer, dating back into before COVID. But it's one of those, at this point, the consumer, when you look back at this chart, if you look at the very top, it's starting to flatten out. Kind of shows the signs that the consumer is starting to reach, I don't want to call it a breaking point, but they're reaching an area that they're starting to really slow down. They're looking at their own balance sheets, things like that. If you looked at the personal savings rate right now, it's below where it was pre-pandemic. It's right around 5%. Historically, it's been between 6 and 7. Doesn't seem like a whole lot, but it is subject to revisions and the like, but it's still down from where it was before the pandemic. And I think that when you look at the overall sign of where the consumer is, it's in a challenging state. They're still spending money, and I think that's a highlight when you look at retail sales versus inflation, that they're still willing to spend that money. They haven't really pulled back. They pulled back in certain areas, furniture, electronics, the discretionary items. That's where Target's earnings were impacted. But they're still spending on things like food, experiences, and the like. So really doing that manufacturing side, still lagging behind. I think there's areas of strength within that, oil and gas being one. If you look at domestic oil production, it's near an all-time high. It's not quite at it, but I think this is a perfect lead-in to hear from the expert himself on the topic, Mr. John Kingston.
Thank you, Tony. I just want to say that it's a well-established fact that people who stay at conferences until the very end advance further in their career than those who don't, especially those who aren't on their phones while presentations are being done. So first of all, let's start with the price of diesel because that's the most important thing. This is a chart since January 1st, 2022. That big spike that you start to see around March, that coincides with the Russian invasion of Ukraine. At the time, the expectation was that about 3 million barrels a day of Russian supply would be taken off the market by public and private sanctions. That actually did happen for a while, though quite frankly, the Russians found ways to rearrange their supply lines, to find new customers, to get away from those who wanted nothing to do with them. Plus, you had the great inflation, and you had a diesel price that reached more than $5.50. This is the EIA price that is the basis for most fuel surcharges. And as you can see, it goes right down to the very end here, and it is now, it is now well under 3. I guess 3.58 was the last one that came out the other day. I mean, that is a really significant decline in not all that long a time. So it's been interesting for us to watch the hits on the weekly diesel story that I do for FreightWaves. They used to be really high, and now they're really low, kind of with the price. Not really low, but people are not as interested anymore because it's not quite a factor. So I'm not going to make any predictions about what is going to happen to the price, but let's talk about some of the factors that are governing the market right now. First of all, okay, we'll start with this. That's a little early, but that's okay. We'll talk about it anyway. As we're going into winter, diesel is a distillate. Heating oil is a distillate too. So the concern in the diesel market is always that if you get too cold of a winter, you're going to have some of those distillate molecules diverted into the diesel into the heating oil pool, and therefore it could tighten up the price of diesel. I am here to tell you that the latest report on U.S. inventories of ultra-low sulfur diesel, which is what goes into trucks, shows that we're in pretty good shape compared to prior years. Our numbers are good. They're a little less than the average of this period, but if you throw out 2020 because that was so distorted, then you're right about at the average. So our stocks of diesel going into the winter are pretty good. The big question that's out there right now has to do with demand. It's really not a supply issue. If you look at the estimates, there's 3 big monthly estimates that come out on supply and demand. One's from the International Energy Agency, another is from OPEC itself, and the third is from the Energy Information Administration, which is the U.S. government. And it's almost like they're all in different worlds. The EIA and EIA both estimate that global demand next year will be up about 1 million barrels a day. That's a very low number. Traditionally, I mean, that's like less than 1% growth in global demand. That is a real slowdown from where it's been, let's say, really for the last 20 to 25 years. OPEC is predicting about a 1.7, 1.8 million barrel a day increase. And what I would argue is that the fate of the price is going to depend a lot on who's right. I think the argument here is the argument here of the IEA is that you look at Chinese demand and it's been very slow. Europe is certainly lagging the rest of the world, and they just don't see a case for a significant increase in demand. I want to give kind of a shout out to battery electric vehicles here, not on an environmental basis. The CEO of Covenant yesterday had some fairly negative things to say. All of these models, these demand models, are estimating that there is no doubt that world demand has been tempered by battery electric vehicles. Yes, they're in a real crisis in the US, no doubt about it. In China, they're 40% of new sales. In Europe, they've displaced gasoline. A lot of gasoline sales, diesel cars are kind of the biggest thing in Europe. And every single model is showing that demand is reduced worldwide as a result of battery electric vehicles, enough that it's showing up in their models. Now, you're probably wondering, how are you benefiting from this? Well, the price of any commodity, but certainly the price of oil, is set at the margin. What is the demand? What's the supply-demand balance for that last widget sold? And I don't think there's any doubt that the price of oil is lower now than it would have been because of battery electric vehicles worldwide. Is it $5 lower? I don't know. Is it $1 lower? Probably a little more than that. Is it $5 lower? Could be. Think of it this way. If it's $5 lower and we consume about 100 million barrels a day, that's a $500 million a day boost to the global economy. So don't discount battery electric vehicles as a factor going in. The other big issue here is on the supply side. What's happened really because of this slowdown in demand, because of the strong numbers out of countries like the U.S., strong supply numbers out of countries like the U.S. and Brazil, and the big story you're probably not aware of is that Guyana has become a really major world producer. As a result of this, the OPEC Plus group, which is OPEC and a lot of countries that are big exporters but aren't in OPEC, led by Russia, have taken about 5 million barrels a day of supply off the market. That's spare capacity sitting on the sidelines. That is the highest ever, except maybe for during the pandemic, but that doesn't count. So what's happened is, if you're wondering why the price of oil is still hanging around $70 a barrel, given all of the negative things I've talked about here, it's really because OPEC and OPEC Plus have done a really tremendous job in keeping supply, stuck in the closet, better than they have traditionally done. So really, that's why it's a $70 price instead of a $50 price. Can they keep doing that? Well, December 1st, they're meeting, I guess, in Vienna to figure out what they're going to do. But there's not a lot of argument for them to increase supply. I think they're going to have a tough time making their own argument. But at the same time, these nations are giving up market share to other countries, and they're not too happy about that. So this is why I say, while I'm not going to make a prediction, you see everything is sort of pointing negatively, pointing really toward a bearish market. I wanted to talk politics a little bit, the whole drill baby drill thing. I think the numbers, the statements made by Darren Woods, the CEO of ExxonMobil recently, are important. He was responding to questions about a new Trump administration and would that allow them to significantly ramp up supply. His argument was that he does not feel that there has been constraints coming out of the Biden administration. I'm sure that he's probably not happy with everything. As you probably are aware, if you're not, the U.S. is producing more oil now. Actually, it's down the last couple of weeks, but as of a few weeks ago, the U.S. is producing more oil than any country has ever done in history. And when you take in the whole supply of petroleum, which is considered to be crude oil plus natural gas liquids like propane and ethane, plus biofuels, we also are producing more petroleum than any nation has done otherwise in the history, really, in history, and we're way ahead of everybody else right now. So I question whether the drill baby drill mantra is going to result in some big supply growth. I want to note the observation of a colleague of mine, or not a colleague, it was somebody I know in the industry, who said back in, let's say, 2018, 2019, the model in this industry was to borrow lots and lots of money. This is really the model in the shale, was to borrow lots and lots of money, drill lots and lots of holes, produce lots and lots of hydrocarbons, produce zero cash flow, free cash flow, and pay zero dividends. And they're not going to do that anymore. The companies that did that have mostly been acquired by bigger companies who have kind of a mature way of doing business. They're going to generate free cash flow. They're going to pay a dividend. So I question whether you're going to get some significant upturn in the price of some significant upturn in U.S. production under a new administration. Let me also note that the supply of oil is also tied to how well the price of natural gas is doing, because that's part of the economics. And the price of natural gas has been, really historically low. Those are the economics involved also in drilling for hydrocarbons in general, whether they're crude oil or whether they're natural gas. And natural gas production in the U.S. is really starting to suffer. Why? Because nobody can make any money at it. So if everybody's thinking about significant lower energy prices, where's the incentive to drill, baby, drill? And with that, I'll bring it to a close. Thank you very much.